In 1987, a bond trader working out of a Beverly Hills office made $550 million in a single year. He wasn't a firm, he wasn't a fund, it was just one guy, Michael Milken, the so called junk bond king, pulling in more personal income in 12 months than most Fortune 500 companies cleared in profit that year. He threw an annual meeting too for his clients, so lavish that it got called the Predator's Ball, and people like Frank Sinatra and Diana Ross would perform for a room full of corporate raiders that he had personally financed. Fun fact, he's one of the real people Gordon Gekko was modeled after. But anyways, 3 years later, he's in a courtroom pleading guilty to securities fraud. And we'll find out that this is actually a super common theme in the finance world, going from the highest paid person on Wall Street to a federal prison. And that pattern repeated over time, over and over again, from back then to today, is kind of the whole crux of our story. Not the rise and fall of one broker, but the rise and fall of the entire industry itself. Go back a little bit further, and being a stockbroker wasn't actually some fantasy. It was a fairly unremarkable, relationship driven functionary job. And for most of American history, it was almost impossible to do a bad job and still get paid. And here's why. The institution that later became the New York Stock Exchange, that grew out of the 1792 Buttonwood Agreement, would roughly, for probably 183 years, operate under a fixed commission schedule, a mandatory minimum fee that every member firm had to charge regardless of how good or bad the advice behind trading stocks was. If you wanted to buy a stock, you paid roughly the same commission. It didn't matter whether your broker was a genius or whether your broker didn't have a day of experience on Wall Street. Competition on price was quite literally against the rules. Now think about what that profit structure rewards. Not investment skill, obviously, and not client outcomes. Volume. A broker earning a fixed cut of every trade, no matter the outcome, had one lever to make more money, and that was to get the client to trade more. We call it the toll booth problem. The broker gets paid at the booth every time a client passes through, whether or not the road the client's paying for leads them anywhere near where they want to be. And for decades, this toll booth model was protected, comfortable, and pretty much uncontroversial because there was nowhere else to go. Then on May 1st, 1975, a day the industry calls Mayday, the SEC eliminated fixed trading commissions entirely and opened the door to real price competition for the first time in the exchange's history. Some established firms tried to hold the line or even raise prices on individuals. They were betting that clients had nowhere else to go. Other brokers read the room correctly and cut trade fees immediately. But one broker, Charles Schwab, did something bolder than either raising or cutting slightly. He cut the commissions by over half. It built an entirely new category of brokerage, the discount brokerage. And he was betting that volume from ordinary investors would beat margin from wealthy ones. And within a few years, competition had made the old guaranteed commission era functionally extinct across the industry. It was a commission race to the bottom. And here's a connection worth noting, even though it's more interpretation than historical fact. Mayday genuinely democratized trading on the New York Stock Exchange, but it also meant that the fat guaranteed commissions on well-known liquid stocks were gone for good. But the toll booth model persisted here and there. And one place that the old toll booth structure could keep surviving was a market that Mayday hadn't really touched at all, and that was penny stocks, thinly traded, barely covered by research, and no meaningful public reference price for clients to check against. The exact kind of security where a broker could still control both sides of the transaction. And that gap is where the next chapter of this story really takes off. By the late 1980s, on the other side of the business entirely, Michael Milken had shown Wall Street something that before it would have never believed. And that was that an individual bond trader with correct instincts could become one of the richest people in the entire country in just a couple of years. Milken pioneered the high-yield junk bonds as a legitimate, enormous financial tool, fueling a wave of corporate takeovers so aggressive that it got its own nickname. That was the merger mania. The junk bond market ballooned from nearly nothing in the 1970s to over 150 billion by the end of the 80s. And Milken's own paycheck went from a meager $5 million to over 550 million in just a couple of years, the highest annual compensation publicly recorded at the time on Wall Street. Around the same time, a very different brokerage was forming on Long Island, and one that would come to define the pop culture perception of Wall Street far more than Milken's junk bond fiasco ever did. In '89, a young broker named Jordan Belfort, his partner Danny Perush, founded Stratton Oakmont. Their business model was the classic pump and dump, which is to quietly buy up shares of an obscure, thinly traded penny stock, then unleash a room of cold calling brokers working from super aggressive scripts to convince strangers across the country to buy that stock at an inflated price. And once enough money poured into the stock and pushed the share price up, Belfort and his partners would sell their own shares into the open market, and this would tank the stock price. And the new investors that they had sold the stock to would end up being the ones holding the bag, a bag full of stock worth a fraction of what they paid for. At its peak, Stratton Oakmont employed more than 1,000 people. Many of them were in their early 20s with essentially no financial background, and they were drawn in by stories of legendary brokers earning 6 or 7 figures of income in 1 year, straight out of training. One early broker described earning over $100,000 in his first month and later $1.5 million a year. The office culture became legendary for excess, drugs, yachts, and a trading room floor that reportedly ran on the motto that you don't hang up the phone until the client buys or dies. This is the image that eventually became the entire cultural shorthand for stockbroker, thanks in large part to the movie adaptation of Belfort's own memoir 3 decades later. But notice something important buried in the timeline. The flashiest, most talked about era in stockbroker excess wasn't actually at the peak of the legitimate profession. It was just at the beginning of its most infamous scandals. Here's the honest, down-to-earth answer to a question that a lot of people probably assume has some dramatic twist involving bribery and bought-out regulators. It really doesn't. The real answer is a lot more boring and, in some ways, more uncomfortable. For most of this era, the legal standard to prove that a broker had traded excessively to generate extra commissions, the practice called churning, was genuinely difficult to meet. To win a churning case, regulators traditionally had to prove 3 things occurred at once. And that was 1, that the trading was excessive relative to the client's own goals, 2, that the broker exercised meaningful control over the account at the time, and 3, that the broker had acted with the actual intent to defraud. That the law calls that scienter. And that element made churning closer to a fraud case, and fraud cases are traditionally hard to win. It wasn't until 2010 that FINRA moved to make this part of the law easier to enforce, adopting a companion standard called quantitative suitability, later formalized as Rule 2111 back in 2012, which kept the requirements of excessive trading and broker control, but it dropped the definitional requirement entirely of proving that fraud was done meaningfully. Now you could violate suitability without having to prove that anyone was trying to defraud anyone else, just that the trading was excessive and controlled by the broker. And that is a significantly lower bar than churning. But it still took between 2010 and 2012 for that lower bar to exist at all as a formal rule. Before that, law enforcement leaned entirely on a much harder churning standard and just whatever case law happened to be laying around and applied. None of that means that fraud went unpunished. Stratton Oakmont was investigated by the SEC as early as 1994, when it paid a $2.5 million settlement, and by 1999, Belfort himself pled guilty to securities fraud and money laundering, serving 22 months in federal prison. He was ordered to pay $110 million in restitution, and his legal obligation to keep paying that actually expired this April 2026, 20 years to the day after his release from prison. Reporting at the time indicated that only a small fraction of that original judgment, roughly 13 to 14 million, had ever actually been collected. Much of it was just from property relinquished at sentencing, rather than money that he voluntarily earned and turned over afterwards. Milken similarly pled guilty in 1990 and paid roughly 1.1 billion in fines, serving 22 months himself. The system did eventually catch up to both of these men, but eventually is pulling a lot of weight in that sentence. Stratton Oakmont operated for roughly 7 years before it finally collapsed, defrauding more than 1,000 investors out of an estimated $200 million. And even the restitution afterward mostly went uncollected. The legal machinery that was supposed to stop this was real. It just moved a lot slower and recovered a lot less than the harm it was responding to. So how much of the Wolf of Wall Street image, the yachts, the drugs, the casual criminality of it all, actually represents what being a stockbroker was like back in the day? The honest answer is probably less than the movie would suggest, but more than the industry would like to admit. Wall Street was less like the movie because Stratton Oakmont itself was always a penny stock pump and dump fraud. It was always a scheme, not a mainstream business practice. The vast majority of brokers throughout this era were working within the legal, if not conflict-riddled, commission structure that was standard at the time, not orchestrating some criminal enterprise on penny stocks. The movie compresses an outlier boiler room into a stand-in for the entire industry. The same way a heist film can make you forget that most bank tellers never laser their way into the bank vault in the middle of the night. Wall Street was also more like the movies than they probably like to admit, because the underlying incentive structure of the fraud itself, get paid on the trade and not the outcome, genuinely was the mainstream business model for most of the 20th century, not just at Stratton Oakmont. The fraud was extreme, but the conflict of interest it was built on top of wasn't unique at all. And that's an uncomfortable nuance that the movie doesn't really have room to go into. The crime was rare, but the incentive that made the crime profitable and manifest in smaller, less obnoxious ways was completely ordinary. By the 1990s and 2000s, several forces converged to dismantle the toll booth stockbroker model almost entirely, and that was independent of any one single scandal. Online discount brokerages kept driving commissions towards zero. By one direct account from Charles Schwab's own pricing history, the firm charged $60 a trade in 1998, and that fell to $14 a trade by 2006. Then a company called Robinhood pushed this further in 2013, offering trading with no commissions at all and building a mass market following, especially among younger investors over the following years. I know because I was one of them. It wasn't until October 2019 that the commission structure kind of broke down altogether, and E-Trade and Interactive Brokers set off a chain reaction across the industry, followed by TD and a couple others. And within a couple of days, the commission-free trading became basically a permanent staple across the industry. Now, at the same time, an entirely different business model was gaining some serious ground, and that was the fee-based registered investment advisor, charging just a percentage of assets under management instead of a commission per trade. The incentive math here is substantially different than the brokerage model. An advisor, paid a percentage of your total account value updated over time, makes more money when your account grows and less money when your account shrinks, whether or not you traded at all that month. It trades one set of conflicts for another. An assets under management advisor might have his own incentive to keep your assets under management rather than see a client pay off debt or start spending their savings, but it removes the direct incentive to generate a commission with every single transaction. The numbers tell the story clearly. The number of registered broker-dealer firms in the U.S. fell from roughly 3,303 back in 2020 to about 2,840 by the end of 2024. That's nearly a 14% drop. Meanwhile, SEC-registered investment advisory firms, the fee-based, hit a record 15,860 by August of 2024, extending a decade of consecutive annual growth. As of recent FINRA data, RIA-only representatives, that's fee-based, make roughly 10% of all securities registered professionals currently, up from about 8% several years before. Consistent with more advisor firms moving towards fee-based models over time, one industry estimate put the stakes in concrete terms. A household paying something like 2.5% annual cost of trading over 20 years versus a 1% annual advisory fee at a 6% assumed rate of return could see a fee difference of over $1 million in ending value. The exact fee structure varies firm to firm and account to account, but the compounding math behind that gap is very real. At this point, the traditional pure commission stockbroker, the Wolf of Wall Street archetype, is closer to an extinct role than a shrinking one. And what's replaced it is a hybrid. When a broker dealer today makes a recommendation to a retail customer, the moment that actually matters for a client's money, that recommendation is generally governed by regulation best interest. That's a 2019 rule requiring that a broker dealer act in the customer's best interest at the specific moment of the trade. Certainly a stronger standard than the old suitability it replaced, though it's built entirely differently and in scope and ongoing application compared to the current fiduciary rules an RIA owes its clients. The best interest only applies the moment of the trade, versus the fiduciary responsibility applies throughout the lifetime of the business relationship. That's one of the more controversial fine print differences in modern finance, and most retail investors have never even heard about that. Increasingly, brokers themselves are actually choosing to become dually registered, holding both a broker-dealer license and an investment advisor registration, so that they can offer commission-based trading when necessary and fee-based advisory services when it's a better fit, rather than being locked into one structure or another. And a huge amount of what a traditional brokerage used to do, like executing basic trades, has simply moved on to investors' phones. Zero commission, no broker required, with apps like Robinhood. So what is the entire life cycle of this profession, from the humble beginnings to the commission-fueled excesses of the 80s and 90s, all the way to its decline and its reinvention, actually teach an investor or an advisor sitting here today? First off, watch what someone is paid to do, not what they say they're doing. A broker paid per trade will, on average, generate more trades, not because every broker is corrupt, but because incentives shape behavior and the margin across the entire industry, whether or not any individual person means for it to be so or not. And that's not a cynical accusation. It's just how toll booths work. And it's a theme we're going to see a lot in these videos. Second, glamour is not credential. The single loudest cultural image of financial success this country has ever produced, yachts and parties and trading floors screaming onto phones, was quite literally the visual signature of an actual active federal investigation of fraud. The excitement that it brought is worth treating as a yellow flag rather than a selling point. And if your financial advisor or broker on Instagram is hanging out with ex-mobsters, Playboy bunnies, and some of the sketchiest influencers the culture has to offer, make sure you can move your money through an app or some other way, because they may perhaps be busy in a courtroom sometime soon. Thirdly, regulation genuinely lags behind harm, and it always will to some degree. It took 35 years after Mayday and after Stratton Oakmont had already come and gone for FINRA to formally codify what excessive trading even was in a single dedicated rule. Some of the protections that exist today are real and meaningfully better than they used to be, but the gap between harm is happening and the rule now clearly prohibits it is never quite zero, and that gap is exactly where the worst scandals tend to exist. Fourth, and maybe the most useful lesson for all, an incentive structure doesn't have to be criminal to be worth questioning. Nobody had to prove Stratton Oakmont's model was fraudulent to notice decades later that a pure commission relationship structurally rewards activity over outcomes. The industry didn't abandon that model because it got caught. Mostly, it abandoned the model because enough people slowly, over decades, started asking the obvious first principle question of who exactly gets paid more if I trade today, And does that person's advice have anything to do with what's actually good for me? A man who once made $550 million in a single year, within 3 years, was in a courtroom explaining himself to a judge. A firm that once employed 1,000 brokers chasing seven-figure incomes was within 7 years gone entirely. Its founder writing a prison memoir that admittedly would later become the very image of what most people now associate with the entire industry and career of a stockbroker. An entire profession that once ran almost unquestioned on getting paid at the volume of a trade rather than the outcome of it has spent 3 decades silently, structurally reorganizing itself around the opposite idea. And nobody planned for that ending back in the 1970s or the 80s. It happened the way most industry wide corrections tend to happen, not from a single lawsuit, but from millions of ordinary decisions being made one investor, one advisor, one trade at a time, each one asking the same version of a simple question that the fixed commission toll booth never was built to answer honestly. And the question is this trade for me or is this trade for you? Thanks for watching. I'll be out with the next one soon. I hope you're enjoying these videos, and it's just kind of fun going over these industry stories. So take care, and I'll talk to you in the next one. Bye-bye.